Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. What a day. We have had another ugly day in risk sentiment. And again, it was Fed inspired. So let's keep the narrative moving right along and see what might be coming up next. Of course, this is a story that we've been following for weeks now, and we stand just ahead of the next inflection point in this narrative. We'll, of course, contextualize the FOMC minutes that we just got today as well. But, of course, the key question now on the minds of the markets is almost certainly, where can there be a lifeline? And the next opportunity for one, if this is in fact the case, is going to be the revision of fourth quarter GDP numbers out of the U.S. That's the next important metric here on the economic docket. So we're going to look through and see what is the possibility that we might get a little bit of a saving grace there for risk sentiment. Does this data even matter, given what we're looking at here developing? And what is the takeaway for stocks? What is the takeaway for the dollar? What's the takeaway for gold? What's the takeaway for a lot of these key assets, all of which seem to be dancing to the same tune, that of the Federal Reserve? So let's jump right in and consider first, before we even look at the expectations, where are we even in the U.S. business cycle? So this is the composite ISM here, both service sector and manufacturing. Needless to say, in the logic of a PMI-style diffusion index is how this is constructed, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so I've picked a couple of important waypoints here, and I've taken a 3-month average to essentially approximate the time horizons that quarterly GDP numbers embody. So what you see there, first, looking on the right, is the December 2022 number for the 3-month average. It's almost not even that important what the number is. What's important is, where are its analogs historically? So you can see there is something in there in between June and September. So there is some sort of a averaging process there. But of course, that gives us something that is right in the midst of the rebound from COVID. So maybe it's not very telling. And then you have to go all the way back to September of 2012 to get a comparable rate of expansion in U.S. services and manufacturing sectors. So these are our analogs. This is what we're looking at. Looking at GDP expectations, we're seeing now the markets anticipate that the 2.9% number that came out in the first estimate of fourth quarter GDP is going to be confirmed this go around, that in fact that 2.9% is where we'll stay. If we look back with this reference in mind, you can see that should be, if we look at the most recent COVID era analog, the average between that dramatic near 30% decline and the 35.3% surge, that of course dramatically exacerbated by first a forced closure of the U.S. economy and then its rapid reopening and the reemergence of activity, thanks largely to the Fed introducing open-ended QE and supporting growth that way. And of course, historically huge fiscal stimulus as well. So Clearly, this is a choppy area, but if we average that, it gives us a growth rate of actually 2.7%. So very, very close to what would be implied by this analysis of essentially attempting to date where December of last year sits and where that quarter sits in the grand scheme of things. It gets a little fuzzier when we go out to 2012. That growth rate just 0.7% in the third quarter of that year, and probably too distant of an analog. Very different conditions then, a very different story about growth and inflation. Still a kind of raw period for the Eurozone debt crisis. And so the situation there probably not as close of a comparison. And so as choppy as the COVID pump and dump here, or rather dump and pump, looks like, we would probably find closer analogs there. So right around 2.7%. And of course, because the spread is so large, a 2.9 number would be essentially in line with expectations for just a casual sort of review of the business cycle's dynamics. It feels about right. And so with that in mind comes the question, does this matter? Would it matter that we got a number that's about as you would expect, looking at the fundamentals, and largely in line with what expectations are? And what would be the consequences? Well, clearly, the lens that markets have on what's going on currently is rooted in Fed policy expectations and speculation on how much the Fed will raise rates ultimately, and how long those rates will stay at the highs. This is clearly the focus. We've talked about it at length, so I won't rehash that here. But suffice it to say, the dynamics of baseline risk instruments, S&P 500, let's say, or even more broadly, the All-Country World Index, MSCI World, which captures global equity. Even if we take the U.S. out of that index, ACWX, if you're looking for the ETF ticker on that, is the All-Country World Index, excluding the U.S. Even there, very, very close adherence to whatever speculation is happening. And you can capture what that is by looking at Fed funds futures. I typically look at the 12-month forward implied rate just to see how things are developing in the outlook 1 year forward. And what you see there is right around late October, early November of last year, a steep rise in that curve stalled, and that curve is rising now again. In other words, the pause in building rate hike expectations gave the markets a reprieve in recent months, and that reprieve appears to have expired. So, will these GDP numbers, let's say they miss expectations, if they were to register a bit lower, does that have the capacity to take the wind out of the sails of speculation here? Does it have capacity to perhaps then give the markets a bid and allow for a bit of recovery? I think the short answer is not very likely so. And this is in looking at where growth dynamics have now shown up since December. We, of course, now have much more data on those more timely indications than we've had when these initial estimates came out. So first, composite PMI numbers for the ISM surveys and those from S&P Global. The latter here, the S&P Global ones, just came out earlier this week and showed that the U.S. economy is back in growth mode. narrowly so, just a bit above 50, but nevertheless in growth mode. The numbers that we got for January, that's from ISM side, strong rebound after a dip deep under that 50 line. So it would seem that whatever happened in the fourth quarter, and you can see from these expectations, it is expected to be a mild slowdown after 2 consecutive quarters of increase. We had that decline of 1.6% early last year, a climb down from a 7% growth rate. And then for 2 consecutive quarters thereafter, growth accelerated. What we're looking for in the fourth is for deceleration. Even so, we can see since then, since the fourth quarter ended, growth has actually done better. That, of course, is inflationary and in a more timely way. We've seen likewise that on the employment side of the story, much of this rethinking about Fed policy was activated by the latest set of non-farm payrolls numbers, that 517 that you see there, which was more than double the expected number, and a 3.4% unemployment rate, the lowest on record for the modern period. So what we then look at is still seemingly an economy that isn't so beaten down as to imply that inflation will continue to necessarily limp lower. Consumer confidence has steadily improved, both in terms of consumers' expectations going forward and their assessment of current conditions. This is from the very timely University of Michigan survey of U.S. consumer confidence. All of these things seemingly saying this is not the time that the Fed might be thinking about letting up, because the economy seems to be still in the kind of state, in particular, as we get into the beginning of this year, where, at least from a growth perspective, inflation does not have the kind of strong headwinds that the Fed would like to erect. Looking at CPI itself, of course, we have looked at this chart before, and it remains highly pertinent. This takes the headline CPI year-on-year number, as well as the PCE, which is the Fed's favorite inflation gauge, the personal consumption expenditure inflation gauge, takes the year-on-year headline rates of both and lags them by 2 months relative to the 2-year break-even rate. The break-even rate is the market's implied inflation expectation as backed out from the difference in nominal yields and inflation-adjusted ones. So when you subtract from the nominal yield the inflation-adjusted yield for a given maturity, I've looked at the shorter end of the curve here, you get the magnitude of that inflation adjustment that takes you from nominal and to the inflation-adjusted yield. And that gives you the market's baked-in inflation expectation. That has led realized CPI and PCE numbers in terms of the peaks and valleys by about 2 months. That, of course, makes sense. The data itself is lagged in terms of how long it takes to collect it, to publish it. Its cadence is monthly, not daily, as bond prices are, and indeed intraday as bond yields are. So you have a more timely sense in those expectations. Furthermore, markets are, of course, forward-looking. So not only are inflation expectations more timely in general, they move in real time when we look at these break-even rates, but also markets are inherently anticipatory in the way that they see things. So you can see that the lag appears to be about 2 months. what you see is where expectations peaked, so too did inflation. But in the past 3 to 5 months or so, not only have expectations stabilized, it seems, after falling, but they're actually accelerating. And that's, of course, a story about all of those green shoots we just talked about on economic growth. PMI numbers for January and February, stronger. NFP numbers, unemployment rate numbers, better. Consumer confidence numbers, better. All of that is giving us inflation expectations that are not surprisingly higher. And so what we're looking at now is a break-even rate that's flirting with 3%. That is not the direction that the Fed wants this to be going. So we're going to get the PCE number for the latest set later this week, and it might confirm the direction of travel here. We're going to get CPI updated a bit later in the days ahead. We'll get more confirmation there. But looking at this relationship, you very clearly see inflation is not going where the Fed is ideally wanting it to go. And so the upshot then is an upshift in where the peak in rates is likely to be. And you can see now for that critical July to September period, we're now looking at rates well into the 5.25% to 5.5% range. You can see very clearly here at the beginning of February where these expectations had been in stasis, really November and to the beginning of this month, and have now been pointedly energized higher. You can see that in the shift in the implied yield curve since the beginning of this month. So you can see the peak now 6 months from now, so essentially call it sometime in August. There is no policy meeting in August, and so because there isn't one, we look at then the peak rate somewhere between July and September, which is why we're looking at these two curves in particular here. And what we see is not only is there a shift meaningfully higher. Recall that peak rate used to be in June and used to be in the 475 to 500 basis point range, about 4.8, 4.9. We've moved aggressively higher since then. So 5.4 now gives us a substantially greater number of rate hikes. It also is suggesting that rates are going to be on a rising path for longer, August, September, rather than June. It also suggested that they're going to remain higher longer. So you now see rates a year from now, so call it late February, March of next year, that are north of 5%. Narrowly so, but nevertheless north of 5%. You don't really see easing of any kind of magnitude at this point until well into next year. And so what you're facing then is a question of whether this GDP data matters, no matter what comes out, or whether it is more akin to what we heard from the FOMC minutes today. And if we consider what that was, what the Fed actually said in these minutes, it seems quite instructive. So almost all Fed officials backed a 25 basis point rate hike at the last meeting, and a few of them backed a 50 basis point rate hike. We've now heard from at least Jim Bullard and Loretta Mester, both FOMC policymakers, but non-voters this go around, who favored a 50 basis point hike. It seems there were more than just them too. We saw that Fed officials continued to see upside inflation risks in the outlook and continuous worry that financial conditions are not matching policy. That essentially we've had a loosening of financial conditions thanks to this rally in shares and other risky assets over the past 3-4 months, and that the hope that Fed officials would have is actually that their tightening would crimp financial conditions, would tighten them. And so there appears to be concern that policymakers have about market behavior, about having not tightened enough or fast enough to really spook investors and keep asset evaluations from encouraging further loosening. And that, of course, another reason with the sort of generalized sense that inflation risks are on the upside, that Fed officials have significant appetite to keep going. All Fed officials, as a matter of fact, looking at these minutes, saw that ongoing increases are appropriate. Interestingly, they also said that risks to the economic outlook are tilted to the downside and that recession this year is plausible. Now, what we might have extracted from this kind of a thing is that, in fact, the Fed is maybe on the course to do another 1 or 2 25 basis point hikes, but that there's increasingly concern about their consequences. We can see what the markets did with this today. Risk continued to suffer. The dollar continued to head higher. Gold continued to head lower. And so the markets clearly looked at this relatively balanced message of there's upside risks to inflation. We don't like the loosening of financial conditions, but recession is not out of the question and risks to growth are on the downside, and basically picked a side. They essentially said what Fed officials care about is the inflation, and they're not going to care nearly as much about these growth risks. And that's the upshot. With that sort of a conflicting message then giving us a very binary outcome, ultimately, the GDP number may well follow a similar script. And so as long as we don't get some sort of a significant different outcome, as long as there's not a almost by definition, unlikely dramatic deviation from forecasts, well, then you end up with a situation where, as with the minutes, the markets take from it that which agrees with the bias they've already picked for themselves. And so it becomes more of a waypoint to get through on the way to where the markets want to go anyway, rather than something that can alter the direction of travel. So if we look at where expectations stand currently, we are looking at fully 100% and more, as a matter of fact, of a rate hike baked in for March. You can see now the likelihood of a 50 basis point hike. That's the percent hike cut column there, and then the next one over, implied rate delta. You can see 121% of a rate hike at 25 basis points baked in, which in English reads as 125 basis point hike definitely expected to occur, 21% chance of a 50 basis point hike seen as a possibility, and you can see the implied rate delta is 30 basis points, so a bit more than a 25 basis point hike. Similarly, we are fully baked in for a 25 basis point hike in May. So it looks like we're going to get a cumulative 50 basis points just in March and May. And then July, June, it seems like we get 75 and more, 79 basis points cumulatively away from where rates are currently, which implies that somewhere in those two meetings, we are going to get a third rate hike. Now, if we add up that 66.5 likelihood and the 25.4 likelihood that we see for the subsequent meeting, you can see the level of conviction starts getting quite impressive. At that point, we are more than 90% sure that we are going to have that third hike. And you can see in the implied rate delta column, by the time you get to July, you are 79 basis points higher than the current setting of policy. So that would mean that 3 25 basis point rate hikes have occurred. Whether they occurred at 3 meetings or whether the Fed decided to go back to 50 at one point and then do one more 25, that we'll have to wait and see. The more interesting thing is we hold then at that level at least through November, with it looks like a slight inkling of a cut somewhere between December and January, maybe taking back to 25 basis points of the 75, but nevertheless above 5 as of next year in January. And that's, of course, a much more hawkish story. If the GDP release is, in fact, just a waypoint on the way to continuing to bake this in, and that we didn't get farther today, just reflects more event risk ahead and thereby a lack of freewheeling conviction, if you will, then we might see further movement here once that event risk is out of the way, and still more movement perhaps when PCE numbers come out on Friday. So with that in mind, still looking like a challenging environment for risk, still looking like a challenging environment for gold, still look like a challenging environment for all things wounded by higher borrowing costs and optimism writ large in this more speculative set of assets that we've seen rallying in recent months. And instead, a favoring of the dollar relative to high beta currencies like the Australian dollar, say. That's been a standout on the weakness side of the column, right alongside shares and gold, and a more constructive view on cash in general, a less constructive view on risk. And that is macro money for today. Once again, I am Ilya Spivak, head of Global Macro here at tastylive. Thank you very much for joining us. We're here Monday through Thursday every single week, right after overtime, with our good friend Chris Vecchio, head of Futures and Forex here at tastylive. In between shows, you can catch my various ideas and opining on financial markets on Twitter at Ilya Spivak. Thanks very much for joining. Godspeed out there in the markets. We'll speak to you tomorrow. Take care.